If you've been watching the markets at all, you already know silver has, well, it's just exploded. We're seeing this massive, undeniable move, the kind that gets those screaming headlines about plus 8% gains in a day and talk of new all-time highs. But today, we're going to look past all that noise. Our mission here isn't just to cheer on the breakout. It's to analyze the core math that the market seems to be, well, ignoring. We're doing a deep dive into a very specific anomaly, a glitch you could call it, with the Sprott Physical Silver Trust, ticker PSLV.
That's right. And for you, listening, this is less about trying to predict the market and more about understanding a really precise valuation problem that we found in the research. When we look at this trust, we're seeing a way for you to, well, right now, to effectively buy $1 worth of real physical silver for about 96 cents. And that mathematical buffer, that immediate discount you get in this kind of volatile market, that's the real story here.
Okay, let's unpack that right away because the details here are everything. The main paradox is that while silver is screaming higher, Wall Street is selling this trust for less than the metal inside it is actually worth. It's almost like a free silver glitch. So let's get straight to the numbers from the analysis. The actual physical value of the silver in the trust, they call it the net asset value, or NAV, is sitting at $27.20 per share.
And before we go any further, it's really important for you to understand what NAV is. The net asset value is. It's non-negotiable. It is the literal, verifiable market price of all the physical silver bars sitting in the vaults at the Royal Canadian Mint, just divided by the number of shares. It's the real intrinsic value.
Okay, the real value. And what's the market selling it for?
The current share price for the Sprott Physical Silver Trust is trading right around $26.04.
Wow. So when you run those two numbers, that gap, that's the opportunity. We're talking about a 4.26% discount?
A bit over 4.25%, yes.
So you're buying into an asset that's in a historic breakout, but you get this immediate mathematical safety net on your entry price. This is that hidden opportunity we're talking about.
And what's really fascinating here is the anomaly itself, because this is, it's the complete opposite of what usually happens. When silver has a massive quick run up like this one, a huge daily move that gets all the headlines, PSLV almost always trades at a premium to its NAV.
A premium? So why would it usually trade for more than it's worth?
Because demand is just so high. Investors are rushing in, they want exposure, and they're willing to pay a little bit extra to get the security of holding real physical metal through a trust like this.
But not today.
Not today. That gap is wide open. The 26.04 stock price just has not caught up to the exploding real value of the metal at 27.20.
So this is a kind of market delay. And what does that delay mean for someone looking to invest? You mentioned this idea of a double lift.
Yes. The double lift is absolutely key to understanding the opportunity here. Let's make it tangible. Say you put $10,000 into PSLV today at this discounted price. You've essentially just bought $10,426 worth of actual silver.
Okay.
The share price has to, at some point, logically catch up to the metal's value. So think about two scenarios. Scenario one, the price of silver just goes flat tomorrow. It doesn't move up or down for a whole week.
Right.
Even if that happens, the PSLV share price should still rise just to close that 4.26% gap. You could potentially make over $400 just from the market correcting its own math.
So that's your safety net, your downside mitigation.
Precisely. Now, scenario two.
Yeah.
Silver keeps going up. In that case, your gains compound. You get the rise in the spot price plus that automatic correction of the discount. It's a really compelling setup when you're chasing this kind of momentum.
That makes perfect sense on the math side of things. So we get the how, the discount. But, a discount is only good if the thing you're buying is worth owning. So we have to ask, what about the why? What are the big catalysts that are driving silver to explode like this? It feels different this time.
It absolutely does. What the analysis is really pointing to is that this whole silver squeeze idea is back, but this time it's being driven by really robust structural fundamentals, not just internet hype. If you connect this to the bigger macro picture, it's just a perfect storm of factors all lining up at once.
Okay, so let's start with the big one, the relationship between gold and silver.
You have to look at the gold-silver ratio.
Yeah.
Gold was the big breakout story earlier this year, right? It hit record highs first. Silver, which is, historically correlated but often lags a bit, is now playing this really aggressive game of catch-up to normalize that ratio. The ratio got severely stretched out, and now the market is snapping back to a more historically normal relationship. Silver's explosion is partly the market just saying, okay, gold's rally was real and silver has to follow.
And then there's the demand side. This seems to be what really separates this cycle from previous ones. It's not just investors buying, it's industry.
That's the key, the industrial panic. Silver is essential. I mean, it's not just for jewelry anymore. It's a critical component in green tech. We're talking solar panels, electric vehicle electronics. We're seeing huge demand pressure from these major industrial players. They have to secure physical inventory to meet their production goals.
And the report we're looking at highlights something specific there, a price range where things get dramatic.
It does. It points out that this pressure accelerates dramatically as the spot price gets near that $70 to $75 range.
Wait, $70 to $75? That's way above where we are now. Why would they start panicking today?
Because they have to plan their supply chains quarters, even years in advance. The second the spot price starts getting near 70, it's a huge red flag to manufacturers that the supply chain is genuinely getting tight. They realize they might not be able to lock in future supply at a good price, or even worse, they might not be able to get it at all. So they are effectively panic buying now to secure their manufacturing lines for the next year.
So it's a forward-looking fear.
It's not speculation for them. It's a real material supply concern for multi-billion-dollar industries.
And all of this is happening against the backdrop of changing monetary policy?
Exactly. You can't ignore the Federal Reserve. Everyone is anticipating rate cuts. And a weakening dollar, which is what you expect from that, generally causes hard commodities like silver to just skyrocket. And silver has this powerful dual nature. It's a monetary hedge like gold, and it's an essential industrial metal. It gets a tailwind from both sides.
So with that strong fundamental story, the specific way you invest becomes even more important. Out of all the ways to buy silver, why does the analysis focus so heavily on the Sprott Physical Silver Trust?
It really comes down to trust and physical integrity. It's especially important if you believe in that supply shortage story. You have to contrast PSLV with other products, like, say, SLV, which is very common. SLV often uses derivatives, paper contracts. So you might be betting on the price of silver, but you aren't actually impacting the physical supply.
But isn't SLV more liquid, easier to trade?
It is, but you're giving up that physical guarantee. PSLV, on the other hand, is fully allocated.
And what does that mean, fully allocated?
It means that every single share you buy represents actual specific earmarked silver bars sitting in the vault. There's no paper shuffling. It's a direct claim on physical metal.
That's a huge distinction, especially if you're betting on a real shortage.
It is. It's critical for the squeeze play. If you think industrial demand is leading to a genuine physical shortage, PSLV is the most direct way to play that on the stock market. When you buy PSLV, you are fundamentally taking physical bars off the market, which tightens the available supply even more and helps accelerate the price movement.
Okay, so now we layer the technicals on top of all this. We have the fundamentals, we have the math. What do the charts say?
The current status is a clear, confirmed breakout. The share price just cleared its 52-week high of $26.06. That's a huge technical signal that shows strong momentum.
And normally when something moves this fast, we'd look for the next resistance level, a previous ceiling. Where is that?
Well, according to the technicians, immediate resistance is basically absent. We are in what they call blue sky territory. When an asset breaks above all its recent price history, there's no old selling pressure overhead.
Yeah.
Its path is really just governed by fundamentals and psychology.
So let's lay out the targets for our listener, given the breakout and that valuation gap.
The analysis points to two immediate targets. First, the crucial short-term one, $27.20.
The NAV.
Exactly. That's the level required just to match the current net asset value and close the discount we've been talking about. That's just the market catching up with reality. Then the second medium-term target is $30. This is seen as a major psychological milestone for silver. Once you clear a big round number like that, momentum can often accelerate.
And just as important, what about the floor for risk management?
Absolutely. The old saying is what was resistance becomes support. So that previous 52-week high is now seen as the new floor. The research designates the key support level at $23.75.
So bringing it all together, the math, the macro, the technicals, what does this all mean?
The verdict from the research is pretty unambiguous. It presents a rare, low-risk, high-reward entry point into what is, a very volatile market.
Let's review the key takeaways for you. The upside, the bull case, is clear. You are buying a breakout asset backed by powerful long-term drivers.
And the safety net, the bear case, is just as compelling. You have that guaranteed safety buffer built in because you were literally buying the asset for nearly 4% below its liquidation value. So the key question now isn't just if silver hits that $30 target. The deeper, more compelling question, drawing on that industrial data, is how fast that industrial panic really accelerates. The spot price continues its climb toward that critical $70 or $75 range. We could see a supply crunch like we've never seen before. That industrial factor is what truly sets this cycle apart, and it's something for you to continue mulling over as you watch this all unfold.